Hello and welcome back to our course on financial modeling and analysis. If you had noticed in the three-statement financial model, we just assumed that the company will not make any more loan repayment. This is almost not realistic in the real-world scenarios, because in the corporate world, companies will normally get into loan agreement, and within this loan agreement, the company will be obliged to pay monthly or quarterly interest rates and part of the loan principal. In this section of the course, we are going to see a standard corporate loan agreement, how it is calculated, how the model is built, and how to link these with a three-statement financial model. Let us assume that our company in this case has decided to take a loan of $75 million to finance part of our capital investment in the long run. This loan has been divided into two tranches. The tranche A loan amount will be $50 million to be repaid quarterly for 8 years with an interest rate of 6%, while the tranche B has a loan amount of $25 million, and the company will have to repay the loan within 32 quarterly periods, that is 8 years in total. But within the first 5 periods, the company will be expected to pay just the interest on capital. Then from the 6th period, the company will begin paying the interest and part of the principal. Let us begin by modeling out tranche A of this loan agreement. We are told that the company gets a $50 million loan to be paid every quarter for the next 8 years. This means the loan will be repaid for 32 periods, given that there are 32 quarters in 8 years. So let us calculate the total payment the company will be making every quarter. First, we calculate the quarterly interest rate, which is going to be equal to annual interest rate divided by 4. So we have a quarterly interest rate of 0.015. Now let us calculate the payment the company is supposed to be making quarterly, which is equal to payment. The first variable is going to be our interest rate, which is 0.015, comma, the number of period, which is 32 period, comma, then the present value is the loan amount we are receiving today, which is equal to $50 million. Then our future value is going to be 0, meaning that by the 32nd period, we must have repaid all the $50 million owed. This means that our company is supposed to make quarterly payments of $1,978,855. Now that we know the quarterly payment to be made by our company, we can now determine which part of the quarterly payment will form interest payments and which part will form the principal. So this loan is supposed to be repaid within 32 periods. That is 0, 1, 2, right up to the 32nd period. So at period 0, which is today, our opening balance, which is the total amount of loan we received from tranche A, is $50,000. Opening balance equals $50,000. And our closing balance is going to be the same, $50,000. Now, from the first quarter, we are still going to have an opening balance of $50,000. In this first quarter, we have to start paying our interest on the loan, which is equal to quarterly interest rate. You fix that with F4 multiplied by $50,000. So we now know the interest we are going to pay in the first quarter. Remember that we also know how much we are supposed to make as total payment for this quarter. The total payment is equal to payment from our calculation. We just negate that value so that we can have a positive value in our amortization table. Since we know the total amount we are paying every quarter, and we just calculated the interest rate to be paid this first period, this means we can easily know the amount to pay for our principal by subtracting the quarterly interest rate from the payment, which is payment minus interest rate. Note that the interest rate you pay is the benefit the lender gets as you use his or her money. This interest does not affect the lender's total sum you borrowed. So to get the closing balance you're owing the lender, this will be equal to opening balance minus principal. So the logical flow continues. The opening balance of what you owe this new period will be the ending balance of what you closed with the last period, which is equal to $48,771,145. The company is going to make the same payment for all 32 periods, so we just fix that and we pull right up to the 32 period. So we can do the same for the interest rate. We just pinch and pull that right up to the 32 period. To get the principal, as we said earlier, is basically equal to payments minus interest rate. We are going to maintain that same formula, so we just pinch and pull that right up to the 32 period. To get our closing balance is equal to opening balance minus principal payment. We just pull and take that through right up to the 32 period. And we do the same for the opening balance. We just pinch and pull that right up to the 32 period. Excellent. We realize that right up to the 32 period, we are going to have a closing balance of 0, which means this company is expected by the 32 period to have liquidated all the loan she is owing. In our next session, we are going to model out the tranche B loan.